All right, here we are again with the same problem, still doing intermittent purchases and sales, but this time they're asking us to do the same thing, but using the LIFO method. So this is the last in, first out. So a lot of the stuff is going to be similar, especially with the journal entries. With the purchases, they're going to be identical. The cash and sales revenues should be the same. The only thing we're changing in the journal entries are the COGS and the inventory. That's the whole purpose of this is to figure out what it cost us in terms of inventory and what are we expensing. So this one should probably go pretty quickly, assuming that you watched the FIFO video right previous to this one. So let's go through it. First one, we don't do anything with the beginning inventory once again. Then we have the January 15 purchase of $150 at $12 each. That journal entry is going to be the same, still inventory cash at $1,800. Then we have the first sale, which is the April 1st sale of $175 at $25. So again, I'm just going to go ahead and put down my journal entry accounts. So cash, sales revenue, COGS, and inventory. Now let's get into the calculations. So again, like I just said, that this is going to be the same because we're not changing anything other than the expense, but just for formality reasons. Let's go through it. Sales revenue is going to give me is going to be what I sold, so the 175 times the $25 I sold them for each, and that's going to give me 4,375. So again, that is going to be my COGS, or excuse me, that's going to be my cash and my sales revenue. All right, that takes care of that. One other thing that I'm going to do is I'm going to put that little slash across the 175 because, again, we're done with it for the purpose of sales. Now let's get into the COGS side. So let's talk about what we need to expense. Well, we need to expense 175. So that's the number that we need to hit. We're using LIFO. Remember, it means last in, first out, or more specifically, it means the most recent from that sale is the first ones that we expense. So it's a bottom-up approach, but we're only going to start with what we know. And as of April 1st, we don't know anything below it, so we have to go above it to the January 15th purchase. So of those 150 that we purchased in January 15th, we're going to take all of them. So 150 at $12 a piece, that's going to give me a total of $1,800. All right, I'm going to put a little slash mark through the 150 in a different direction. Let me know I don't have any more of those left. I still haven't hit 175, so I need to pull out 25 more, and I'm going to pull those from the beginning inventory. So I'm going to say 25 at $10 a piece. That's going to be $250. Again, I'm going to put a little slash mark through the 50 because I don't have those anymore, but I do have 25 still. So I'm going to put myself a note that says, hey, don't forget, you still have 25 from the beginning inventory. Now I'm going to add up the $1,800 and the $250. That's going to give me a total of $2,050. And again, that's going to be my COGS. So I'm going to put that in my journal entry. All right, that takes care of the first sale. Now let's go to the May purchase of $200. That's going to be the same as it was before. As a matter of fact, so is the June 2nd purchase. So I'm just going to go ahead and put those down as inventory and cash. The May one is going to be $3,000 on each, and then the June one is going to be $3,600. And I just multiplied 2,000 times 15 and 225 times 16. All right, now we get to the 7-Eleven sale. Again, I'm going to go ahead and put my accounts down: cash, sales revenue, costs, or COGS, and inventory. Let's go ahead and calculate the sales revenue. It's going to be the same as it was before, but just for, again, formality reasons, I want to show you how we do it. It's going to be the 430 times the $25 a piece that we sold them for, and that will give me a total of $10,750. I'm going to go ahead and put that in my journal entry, $10,750 for both cash and sales revenue. Now I'm going to put a little slash through the 430 because we are finished with that. I don't want to mistakenly use that. Now we have to expense those 430. So 430 is the number that we have to hit. Again, we're going to start with the most recent of that sale. So the most recent purchase from that sale is the 6/2 purchase of the 225 at 16. So I'm going to start there. I'm going to pull all 225 out of there. So 225 at 16, that's going to give me 3,600. I'm going to put a little slash through the 225 because we don't have any more of those. I haven't hit 430 yet, so I need to pull some more. Where am I going to pull that from? What's the next one going up, which is the 5/1 purchase. And of those 200, I'm going to pull all 200 of those out. So 200 at $15 a piece, that's going to be 3,000. Put a little slash mark through the 200 because we don't have any more of those. Now currently we're sitting at 425. We have not hit 430 yet, so we still need to pull 5 more. And the only place we can pull 5 more is all the way from the beginning inventory. So I'm going to pull 5 of those. So 5 at $10 a piece. That's going to give me $50. Put a little slash mark through that 25 that we have at the top, because we don't have 25 anymore. We have 20 now. So again, I left myself that little note that says, hey, don't forget we still have 20 of the beginning inventory. Add up those amounts, the 3,600, the 3,000, and the 50. That's going to give me a total of 6,650, and that's going to be my COGS for this sale. So put that in my journal entry, 6650, 6650. All right, so now we're done with all of the journal entries. Now let's get into those things that we were finding before: the cost of goods sold, the gross profit, the ending inventory. And I'm going to go ahead and start with, again, the total revenue. So total revenue, again, is just looking at the 2 sales revenue line items on our journal entry, adding them up. So sales revenue equals the 4375 plus the 10,750. That's going to give me a total revenue of 15,125. That hasn't changed since when we did it in the FIFO. It's the same as FIFO. And that's pretty much how it's going to be when we do weighted average too, because the only thing we're changing is COGS. All right, let's look at total COGS. Again, we're just going to look at the 2 line items that says cost of goods sold, add them up. So 2,050 plus 6,650. That's going to give me a total COGS of 8,700. All right, so now we're going to the gross profit. Gross profit is just simply the difference between those 2 numbers. Sales revenues minus COGS. So sales revenue, again, is 15,125. COGS is 8,700. And if I subtract the 2, that's going to give me a difference of 6,425. That is my gross profit. That is what I made on the sale alone. And then finally, the last thing is the ending inventory. Now we know, we just said this in the last video, that FIFO, it was 20 units. And LIFO is going to be 20 units as well. And when we do weighted average, it's going to be 20 units as well. But the important part is how much those 20 units cost. So that's 20 units. If we go all the way back up to the beginning inventory, that is $10 a piece. So at $10, that will give us an ending inventory of $200. And that is how you do an intermittent purchase and sale example using LIFO. Hopefully that made sense. Hopefully it wasn't too brutal. In the next video, we're going to be doing the weighted average. So hopefully this is good enough for this one. So y'all have a good one.